Ciaara Hoffman, and today we have our guest Jennings Smith with My First Million in Multifamily. Jennings, I'm excited to have you on the show.
What's up, Ciaara? Thank you for having me. I appreciate the invitation.
Awesome. So before we kick things off here, I just wanted to, tell the audience about your story, your background, and how did you get into commercial real estate?
Okay, yeah. So I was a contractor for 16 years, and I was renovating houses, bathroom, building houses, kitchens, that sort of thing. And in 2009, 8, 9, things were bad, and I owed the IRS money. I had a couple, I was in a rental home, and I was trying to renovate my new home. That was going over budget. My business was losing 50 grand. I had all these employees. I was literally working all day and then door knocking to try and install those little Home Depot like peep sites in people's doors to make an extra $100 a day. Like I'd buy them for $5, charge them $20, and if I knocked enough doors, I could make an extra $100, and I needed that to like pay my bills in 2009. Like it was not fun, and
Wow.
But it taught me what I was made of. Like, hey, I'm not going under. Like, no matter what it takes, I'm not going under. And so, but I also realized I don't want to be in this situation again, and I need to get something because there's going to be other market cycles. And I think that people that are in certain industries, like they're a realtor, they're a mortgage broker, they're a contractor, they're in retail, whatever, they're going to be affected by economic turndowns. And it's foolish to think that that's not going to happen. Like we're probably on the brink of it happening again. It's kind of already starting to happen. And so my thought was like, I'm going to be ready. Like I'm not going through this again. And so I started to buy mobile homes. I bought a double wide and became my landlord. I bought it for $5,000 and I fixed it up myself. And the guy promptly destroyed it. Dogs quit paying me. He was not qualified, but I learned by trial by fire, like how to be a landlord or how to not to be a landlord. But it built, and I bought another trailer. That one worked. It was a rental. I bought a rental house. I bought another rental house, and now I've got like $1,000 a month in passive income, and I'm building equity, at least in the rental homes. And then I realized, well, this is going to take me forever to do this just one at a time, saving up 20 grand for a down payment. So let me switch to multifamily and self-storage and bigger projects and how to raise capital, how to joint venture, how to do syndications, how to get other people to buy into my dreams so that I can do that. And so I closed my first deal with owner financing, and I had an investor that gave me the down payment and no money down out of my pocket. And I realized, dude, if I can do this with 12 units, I can do this with 100 or 1,000. And that's where we took it over the next 3 years. We took it to 1,000 apartments and 500 self-storage units and a couple trailer parks as well. And yeah, it's been a fun journey. And I'm a lot happier and a lot more financially secure for this round coming up, so.
Yeah. Perfect. Yeah, I think we are heading into maybe a recession right now. A lot of people are, talking about it, and there's a lot of uncertainty in the market. Have you noticed anything, with your investors? How are they feeling right now with, we're heading into 2023?
Yeah, I think there's this soundbite that is getting reiterated of we're about to go off of a cliff and hang on to your dry powder and it's going to get really, really bad. And I think it sells and it drives attention, but you got to realize the world has changed. Social media has changed. And when the more outrageous you are, the more ridiculous you are, the more contrarian and combative, then the more eyeballs and attention you're going to get. It's just like the news. The news wants to sensationalize everything. And so the kind of people that are in the middle of the road, they're not as popular. But I think that that's probably the most accurate assessment of what's going to happen, right? Rates are going to go up. They just got raised in November. They're probably going to get raised in December. They're probably going to get raised in January. And then we don't know what's going to happen, but most likely they're going to stop. I think, Jerome Powell doesn't seem to be influenced by the political landscape as much, which is good. But I do think that what goes up must come down. And I don't think America's on the brink of collapse. I don't think the dollar's on the brink of collapse. I think our economy is in just fine shape overall. And I think that we are going to come through this. I think this summer it's going to cool off. They're going to stop raising rates. And then possibly this fall or next fall in 2023, they're going to start maybe even lowering the rates. And then what's going to happen is the stock market's going to explode. The crypto markets are going to explode. The real estate market is going to be back. I mean, the housing market is going to be back because all this demand is still there, and yeah, people are waiting, seeing what's going to happen, but the demand is still there. And so when there's the slightest rosy outlook, it's going to blow. And so the people that have been disciplined in buying and meeting their criteria over this coming year, they're going to look really smart come the end of 2023. And that's my plan right now. We just closed the deal 2 weeks ago. I closed another one earlier this year. We got one that's closing, another self-storage facility that's closing next week. So we're still buying. We're just being disciplined with what we're buying.
Exactly. Yeah, I think, when you're in a downturn market, that's when the opportunities arise. So we got to prepare ourselves so that we're in a position where we can acquire properties when the prices are low and we're buying at a discount. So I think obviously you're set for where you're at. Can you tell us about what your portfolio looks like today?
Well, and, Ciaara, I'm not perfect and I'm not set. And I want to talk to you about some of the stuff that I've done wrong and that I've set myself up for some pain that I'm in right now so that maybe your listeners can avoid some of that. 2 years ago, I was taking on bridge debt. I was taking on stuff that expires and expires like soon. Like I got a loan expiring in March. Okay. So that's right around the corner. I've got another loan that I've still got a year on it, but it's on a floating rate. So I'm getting hammered, right? Every time the Fed raises rates, they're like, oh, your payment went up. Oh, your payment went up. Your payment went up. It started at 7%. We're over 9 now. And so, that's not fun. And one of those deals I exited about a month ago and we made $1 million profit on it. So it wasn't like all bad, but I set myself up I wasn't thinking a year ago this could happen, right? Nobody could foresee that rates would be this high a year ago. Everything looked phenomenal. And the other deal that I'm on the floating rate, like we're close to closing that one as well. And then the one in March, I have 2 1-year extensions on that, and I've also got 2 parties that are interested in buying it, so I'm okay. But what I'm trying to say is, in real estate, it's super forgiving if you have time. And the people that get hurt are the ones that get put over a barrel and they just don't have any time. They don't have any options. They can't refinance. They can't sell. They can't extend. And they have to sell fire sale. And so if you're a buyer, obviously you want to look for something like that. But as a seller, you don't want to be in that scenario. And so I've been preaching, keep buying as long as it cash flows, meets your criteria, and you can get long-term fixed debt on it. If you can get a 5-year loan and it works at 7 3/4 or 8 or whatever rate you're getting quoted right now, if it works there and you can secure a 5-6 year term, well, in 2 to 3 years when the rates are back at 5% or 4%, refinance that baby and you're going to look really smart. It's going to cash flow extremely well now. And so don't be afraid to buy, but don't get yourself into a 1-year bridge, a 2-year bridge. Because what if I'm wrong? What if this summer they raise rates to 10 and this fall they raise rates to 12? And it's like, well, Jennings was a total idiot. We did fall off the cliff. You're going to be glad you're not in a short-term bridge loan.
That makes sense. So preparing ourselves for, where the future can head. And so you mentioned, you have some self-storage, some apartments and some mobile home parks. Now, we've never had anyone on the show talk about self-storage. Can you tell us more about how you got into that, the differences between that versus apartment buildings?
Yeah. So self-storage is a good field. I don't know that it's as durable, recession proof as multifamily, but it's close, because in recessions, people are moving around, they're storing stuff. They have to downsize from their office and they still got to put their crap somewhere. I mean, recession's not great for self-storage, but it's not horrible. And the biggest difference with self-storage is you have a lot of turnover. You have a lot more turnover, especially if you're in the parking, like boats and RVs and stuff. It's more turnover than multifamily.
Mm-hmm.
The dollars are smaller. You're renting something out for $100, $150 versus $1,000. So 500 units in self-storage is pretty much equivalent to 50 units in multifamily. And the expense ratio is much lower. You're talking 25 to 35% on the expense ratio versus, 40 to 60% on multifamily, depending on the class of asset. So, and it is more passive to manage it than a multifamily, but it is still definitely management. So my sister, Crystal, Miss Multifamily, I don't know if you know her, but she manages the self-storage place, and she's got a remote gate. She's got remote security system. People have their own code on their cell phone. Like, she's got it so that we don't have to be sitting there all day, every day. But she still is running ads, lease up specials, running, Facebook ads. And she's got that thing at like 90, 95 or 99% occupancy. She's running it great. And we took the rent roll from 9,500 to 15,000 in a year, year and a half. So we're doing well, but still, it's only $15,000 a month. I mean, that's pretty small for like an apartment. That's only like a 12, 13, 15 unit apartment. So, but I got it for free, right? I mean, I got that property for free, so I'm definitely not going to turn it down. I negotiated a seller carryback where we got a loan from a bank, and then the seller financed my down payment, the whole thing, and more than enough. And I actually got $60,000 at closing and didn't put any money down. So I had no investors, no partners other than Yaden, my cousin, and my sister. And so that was a good deal to amortize debt, control real estate. We've got long fixed term debt on it, and the rent rolls where we need it to be. So the only thing we got to do is refinance and get the guy that, the original seller, his money back, but that won't be too hard.
Got it. So it sounds like you kind of still lean more towards investing in apartments versus anything else. Is that right?
I mean, I think that when you're starting out, you don't need to be crazy picky. Okay. This maybe is different than gurus say or whatever, where they're like, pick out your market, pick out your asset class, pick out this, and you're going to buy only this. And it's like, my thought is, in the beginning, you need to get a deal done, right? You need to do the repetitions. So if you see a trailer come on the market that looks like a good deal that you can rent, buy it. A single family home, buy it. A small little trailer park, get it. A self-storage facility that you can get with no money down or seller financing or whatever, get it. Get your feet wet, and then refine and say, okay, I really my ideal is 80 units and above in the Southeast, multifamily, B minus, blah, 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 blah. I already have a portfolio, and now that's what I'm going to really focus on because that's where the money is, or whatever you think, or that's what you like. But I think that there are a lot of people that never close a deal because they're waiting for, Mr. Right to come along, and Mr. Right never comes along. You need to be thinking about Mr. Right now. So it's a give and take there. And I think that you need to take opportunity as it comes to you versus just waiting on the perfect deal.
Yeah, that makes sense. So not being stuck in analysis paralysis. I think there's just so many ways to invest in real estate, and some people get stuck on, what do I do? Like there's just, should I do self-storage? Should I do apartments? Should I do this? And I guess it's just finding that opportunity, committing to, a certain strategy, whether it's value add or anything else like that, and just taking action. So what is your strategy when you're looking at acquiring something? You use mainly the BRRRR method. Like, what are you looking at right now?
Yeah. I mean, the BRRRR is the gold standard. That's the ultimate, where you can buy it, refinance everybody out, and hold it forever. And just keep refinancing it every 5 to 7 years. That's a great strategy. But not everything works with that model. But yeah, if my first, it's kind of like, how hungry am I? If I've just closed something, or I'm very busy, overwhelmed with some bunch of stuff, I'm not going to look at something if it doesn't fit the BRRRR model. Like, if I can't refinance everybody out in 2 to 3 years, then I'll just pass. But then there's definitely deals to look at where maybe it doesn't quite fit that, but you can still sell it in 2 to 3 years, and you can still make a 15 to 20% return for everybody. And it just depends on your level of opportunity. If you're investing in the stock market and all you've ever gotten is 8%, and somebody throws a 15% syndication deal at you, you're going to go for it. But if you're like looking at 20 to 30% deals all the time, and somebody throws a 15% opportunity at you, you're not as inclined. And so I think it just depends on the amount of opportunity you have at the time. So right now I'm being pretty disciplined. I have not bought much compared to what I was buying in 2019 and 2020. 2021, I closed probably 400 or 500 units, but then 2022, only closed 2 deals. And that was like a major slowdown from my previous pace. But I'm like, it's expensive. I'm not seeing what I used to buying. I felt like I stretched myself a little bit in 2021. And if I stretched a little bit further in 2022, I'd be regretting it. And lo and behold, like, I'm really glad that I didn't pay the top dollar prices. I mean, 2022, end of 21 and beginning of 2022, it was insane. I mean, we've never seen anything like that. You put a house on the market and you're getting 50 full price cash offers. It's like, what is going on here? So I was just not going to participate in that.
Got it. So are you anticipating 2023 is going to be heavier on the acquisition side then?
I think so, because I don't think we're going to fall off a cliff, but it's like people are going to get reasonable again, where if I'm talking with a seller and he's like, I want full price, I want hard money day one, I want no financing contingency, I want like, he can't be that picky anymore. And so now I can negotiate, and I can negotiate some seller financing, I can negotiate seller carryback, I can negotiate on terms, I can negotiate on earnest money. And then there will be some people, select people, that are really motivated, right? They have a loan expiring, they have a reason that they need to sell, and they're going to be flexible. And back in 2021 and 2022, there really was no reason to be motivated. If you held it, like in 6 months, it's probably gonna be worth more than it is now. So I don't care. If you don't like the deal, then walk. It was the seller's opinion. So I think that 2023 is going to be the challenge is going to be probably the money. Like it's crazy. It's like it's either easy to close deals and hard to get the money, or it's hard to get the money and easy to close deals. And I think we're going to be going into, like, there's more deals, but the banks are going to be tighter, the rates are higher. I think investors are going to be scared, right? That maybe investors that invested in syndications in 20 and 2021 are now seeing their returns being decimated, and they're not as likely to jump back into the next deal. I think that people are just going to be overall afraid and want to hold on to their cash. So it may be harder to raise capital in 2023. And this is where you've got to have, you got to dig the well, right? You've got to be putting out content, putting out messaging, attracting the investors, because if you have a wide enough base, there's definitely people that are still going to be interested in investing in real estate and wanting to do that, especially if you have a great deal.
Perfect. And so right now, where are you looking at acquiring properties? What areas, what markets are you looking at?
I mean, I won't say no to most markets. I mean, if the deal makes sense and I have local knowledge and like partner there that is connected there, I won't say no. I mean, there are definitely markets that I'll avoid. You know, I'm not going to be buying in California or Chicago or New York, but
Hmm.
if somebody brings me a deal that makes sense in Texas, well, I haven't bought a property in Texas yet, but I'm not against that. I'm not against Florida or Mississippi or Louisiana or
Hmm.
whatever. But I mean, I mostly focus on the Southeast. You know, a lot of my stuff's in Georgia, South Carolina, Alabama, North Carolina. Um, and then I have a property in Tulsa, Oklahoma. I would definitely buy more in Oklahoma. So if you're listening to this and you got a deal in Oklahoma, let me know. And then I would buy more in Indiana. I've got some stuff in Indiana. I've done really well with that. And I bought in Illinois, which I never would have thought that I would buy in Illinois, but I bought in Illinois, and that deal is turning out fine. You know, we bought it right. Like I think 40 or 45,000 a door, and we're renting them for 650 to 750, and it's chugging along just fine. So that's why I don't make these rules of like, oh, I'm not going to buy in Illinois because that's a blue state, or they don't have tenant friendly, landlord friendly laws. You got to take it by case basis. So I'm really more looking at, does it meet my underwriting criteria? Is it a growing population? Is it a
Hmm.
good, I mean, I do look at landlord friendly states, and is it cash flowing? What's the upside? Is there value add? Can I raise the money? What are the terms? Can I get investors excited about this deal? And so that's kind of what I'm more looking for.
Got it. And so, the way we met was through, your Facebook group, My First Million in Multifamily. I joined the group. I saw everyone in that group it seemed like every day someone was closing a deal. I was like, man, what is this? What is this group? Everyone here is actually, investing. They're not just talking about it. Everyone's making money in here. So, that's why I jumped into the deal room. When did you start that? And how has that kind of grown your business?
So I started the Facebook group, My First Million in Multifamily, about, I think, like 2 years ago. And I had just been posting in other multifamily groups and posting on my personal page and getting some feedback, good feedback. But I'm thinking, why don't I? Well, admins were banning me. They were kicking me out. They didn't like me. Like I had to play by their rules. And I'm like, why don't I create my own group and I can be the
Yeah.
the banning person? So but I did it so that I could attract investors and that I could attract deal flow and partnerships and stuff. And so
Hmm.
I did it, and I saw a lot of these groups. People would start them, they would be excited about them for a little while, and then they would just go dead, and nobody was driving the group. And I thought,
Mm.
if I can consistently drive this group, there's going to be a need for this. And a lot of these groups were also filled with spam, cryptocurrency stuff
Yeah.
and all sorts of crazy, this guy helped me make money, blah, blah, blah. So I'm thinking, if I can really make a quality product here, the market will want it. And so we did that. And I mean, we did 2 shows a week. I'm actually doing a show in 30 minutes, as you know, Ciaara. And we do 2 shows a week at the time, and just like consistently keeping it clean from the spammers and good content. And it grew, to a few thousand, to 10,000, to 25,000, which is where it is now. And I realized I changed my life. This stuff changed my life by getting out of a life of desperation that I really didn't like,
Hmm.
scraping by. And it's not that hard. Like, if I can show people a path, they can do it as well. They just need a track to run on. If they're willing to copy and do the work and show up, then they'll get the result. And if they get the result, like it could be huge. I mean, one apartment deal can be worth millions of dollars in equity in your retirement. Like, you could work for 40 years for some Fortune 500 company, saving, $3,000-4,000 a month and trying to sock it away into the S&P 500, or you can close one deal. And that same deal, you're amortizing a few $1,000s a month in rent and in your mortgage. And it just keeps going up with the inflation and the valuation. and your retirement is done. And if you want to keep on building it because you're addicted to it now and it's fun, you can be really wealthy. You can have $100 million portfolio in less than 5 years, right? That is not an unreasonable thing to think could happen. And what other vehicle can the average person do that with? And so I got this passion for teaching people because they're reaching out to me. I was like, I need to have a formulated track for them to run on. And so I built a course and realized that wasn't the key. Like the course, people need education, but what they need is a community. Like I need a loan sponsor. I need somebody to help me raise money. I need somebody to look over my deal with me and tell me this deal sucks or this deal is good. I need partners. I need boots on the ground. I need local knowledge. Like I need a community around me to push me forward. And that's how I'm going to close a deal. And it's been effective. I mean, you see the posts. It's like every week we're getting at least a couple deals coming out of the deal room. People put stuff under contract, closing stuff, refinancing stuff, wholesaling stuff, making serious money versus just like dreaming about someday maybe making this happen.
Yeah, no, it's amazing what you can accomplish when you create that kind of community. I think, especially in this business, relationships, partnerships are super important. You can't do it on your own if you want to scale and you want to get things done. So what is kind of your core strength when it comes to commercial real estate, and what do you delegate, or what do you let partners take over?
So in the beginning, you got to be good at something, and the more stuff you can be good at, the better. I'm not a proponent of I want to delegate everything and I'm going to build systems and teams, and like, fine. When you're a multi-millionaire, you can do that. And I definitely think you should do that. But when you're starting off, those types, it's like, what do you bring to the table? You know, to somebody like myself, where you don't really know property management. You don't know asset management. You can't raise money. You don't have broker relationships. You don't know how to underwrite that well. You just bring the desire of, I want to be a multifamily investor. Like, so does everybody else. I want a $10 million. Like, I don't care. And so my advice is get good at something that's hard. Get good at something that's hard and bring value. Raising capital, that's valuable. That's getting good at something hard. Being a phenomenal underwriter and understanding how that stuff works inside and out, that's valuable. You know, building relationships with brokers and cold calling and building the text and mass text and email systems, that's valuable. You know, saying, well, I'm going to be like, I just want a piece of the deal and I really don't want to be that good or work that hard at anything, that's not valuable. And so my model now that I'm at where I'm at is, yeah, I have property managers that manage my properties. I've now hired an asset management consultant to help me manage my stuff better. Yaden does a lot on the back end of the deal room. And so my focus is now driving awareness, right? Driving more people into our Facebook group, more people that know who we are so that they want to invest with us. They want to join the deal room. They want to bring us deals. They want to partner with us, get to know us. That is my highest and best use now. But when I was starting, it was like Yaden and I started a property management company. So we learned property management. We learned the underwriting. We raised the capital. We cold called the apartment owners. Like, we did it and built those skills so that we could attract wealthy people who would partner with us and give us money and sponsor our loans and put us on. And that doesn't happen if you don't have like tangible, real skills in the marketplace.
Got it. Thank you. We really appreciate your time today, Jennings. Where can people find you if they want to get in touch?
Yeah. Just go to my website, Jennings Smith Jr. So JenningsSmithJR.com. You can join the Facebook group if you do that. We can give you, a free deal analyzer, a pitch deck on how to raise capital, some other downloads and PDFs, just tools to get you started in multifamily. My podcast is there. The deal room is there. It's all at JenningsSmithJR.com.
Perfect. And I'll make sure to include a link to that in the show notes. Thanks again for being on the show, Jennings. And we'll talk soon.
Yeah, Ciaara, it was a lot of fun. Thank you.
Today's show was sponsored by Synergy Capital Investments. To download your free multifamily investment guide for beginners or to schedule a call to learn about our upcoming investment projects, go to thrivewithsynergy.com. That's thrivewithsynergy.com or click on the link below.